Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thanks for tuning in. I'm joined by Brian London. And our special guest is Frank Holmes. He is the Chief Executive and Chief Investment Officer of U.S. Global Investors. He's a commentator on financial networks such as CNBC, Bloomberg, BNN, and Fox Business. I assume the BNN is because you're Canadian originally. And he has written for Forbes, Business Insider, Seeking Alpha, and the Wall Street Journal Experts Corner. Frank, welcome to the show.
Oh, it's great to chat with y'all.
Yeah, and actually, just as an aside, how long have you been down in Texas?
30 years, so I'm a full-fledged Texcan. Y'all come back, eh?
I remember when you went down there, actually. I'm one of the survivors in this industry that can go back that far.
Wow. Frank, I've been listening to a few of your interviews, and you've been putting out some provocative statements that you just think things can go higher or there's a great deal of promise still. You're still bullish on gold. But one area where maybe there's vulnerability or where there hasn't been so much traction is in the juniors. So, and Brian is curious to know why you think that is.
Well, I think that what's happened is, and I see this in the mutual fund world, that we experience continuous redemptions. A year ago, Vanguard got out of the gold mutual fund business, and they changed their status. And we went and back tested 1, 3, 5, and 10-year periods, and our gold funds outperformed them. But they were much bigger, and because they were cheaper. And so there's been a psychology, I'm told, is just changing, but the psychology is cheaper is better, and there's no need to pay for performance. And so you saw that the sort of pervasive throughout the industry, and it morphed in Canada, it morphed here. And I think that that's really important to recognize, is that the gold business, the gold fund business, it's been a net exit, and because a lot of equities, the junior mining, et cetera, were in gold mutual funds.
Right.
Even when you put on good performance, you're not getting the traction. Now, it's much harder now with all the regulations for me to communicate, to sell. There's more disclaimers than there is allowed to tell you why it's a good idea. And I understand, it's always to protect the retail investor. But this concept of the classic would be the fiduciary rule and understanding of it. It came out of the EU after the 2008 crisis, and socialism, the bureaucrats got control of the narrative. And they basically crushed England with it. And the interpretation in England was to help all the retail people. And what they've done with this is they ignore the fact that the crisis of '08 was leverage. It was where brokers were allowed to leverage 33-1, which shocked me. And people could buy houses 95% debt, 5% down. All crises have to do with leverage. And so they basically now tagged junior mining as being risky. And then it was part of the crisis, and all small cap investing and all private placements, when it's really a false statement. Leverage is totally different as a factor. And this rule, this interpretation rule, and then you had MiFID II come out last year. And so I'm going to dovetail the two for you. First, the fiduciary rule is basically orphaned all retail investors because it's too costly to talk to them. They are not getting the better advice. They're not getting any help. And then the rule became totally accepted in Canada because Canada's much more, the word is progressive, they like to say, but that's really a false narrative for we're socialists. We're socialists.
Sure, yeah.
And it's a form over substance. It's not politically correct to say I'm a socialist. It's politically correct to say I'm a progressive. And so they basically embraced it. And the big banks, which control 80% of the business, basically said that anyone over the age of 65 can't speculate. You can buy options, you can buy triple leverage ETFs, but you can't buy junior mining. You can go to the racetrack, you can go to a casino and buy a lottery ticket, but speculating in junior mining. So you saw all of a sudden the banks could not recommend, their brokers were prohibited from championing a junior mining stock or any junior stock, period. And this led in usher in, I saw with the launch of, actually I launched the first crypto mining company, Hive. And what I noticed in 2017, that year, was this huge number of $5 billion going into speculating on these new crypto coins. Why wasn't it going in gold mining? Well, because there was no barriers, there was no bureaucracy of fiduciary rule. They could trade 24/7. There was zero regulations, and I'm always believe you need some form of regulations, like referees in a sporting event. But this money, all of a sudden, with the millennials say, well, why do I want to buy a junior mining stock? I get more action and excitement betting on this new crypto coin. So you have these this is where the money went. And then we saw in the U.S. the interpretation of the fiduciary rule, which is interesting because it was the Department of Labor, which is basically the Department of Socialism, was the one trying to take over the SEC's turf. And there became a turf war. But under Obama, the Department of Labor was getting more traction, and they were coming up with a policy which basically got morphed. But what happened was that many of the institutions started to have to embrace it, and their interpretation was that let's not buy any stock under $10. Let's not buy any company market cap under $200 million. And so a Merrill Lynch broker cannot take an order for stocks, I was told, under $200 million. They can't solicit orders. So that basically really hurt that mining sector. And the newsletter writers predominantly could easily go into cannabis, but those people that could take a cannabis trade had to go through Fidelity's national securities firm or through TD Waterhouse or Schwab to buy those stocks, but not junior mining. And so the interpretation that really also hurt mutual funds, because the big platforms from the Merrill Lynches of the world, the UBS, et cetera, so, well, we're going to get sued based on expense ratios, and if the expense ratios are in the bottom half or the bottom quartile, then we got to kick them off our platforms. So a lot of the gold funds got kicked off platforms, and it was predominantly down there was Vanguard. And then Vanguard a year ago got out of the business.
And that was a real sign at the bottom, wasn't it?
Absolutely.
The bell ringing at the bottom. But don't you feel that a big part of it also is the fact that when all markets are driven by central bank monetary policy, by this need for ever easier money, not just easy money policies, but ever easier money, they always need this new adrenaline hit. And the central banks have given the markets what they want. With this unprecedented level of monetary reflation, et cetera, in this kind of an environment, all correlations go toward one. Bonds rise, equities rise, and it's really ushered in this era of passive investing where people are investing in ETFs, unmanaged products, low-cost management fees, the lowest that they can get. And they've been rewarded by that, by just investing in the indices. So you have that going on, but in mining, it's one of those areas still where there is it's not as efficient, where there can be an advantage given to good management. I mean, you look at the GDX and the GDXJ, there's only a paper-thin difference between the two now because the GDXJ has gotten so large. There's really no focus. There's no real ETF ability to invest in these junior miners where you can get these outsized, 2, 3, 4, even 10-time gainers if you get into the right companies at the right time.
That's so true, but it's getting to that investor in the marketplace, and I just see things being islanded more and more.
Mm-hmm.
Like, Brian, a classic would be MiFID II. So MiFID II comes from the EU, gets pushed in the UK, then gets pushed in the US, and $1 billion of research analysts are gone. And when we get these reports from UBS or whatever, it's a one-page teaser, and you got to click through. And if you don't give $50,000 or $100,000 of commission business or hard dollars, you can't read the research report. That's what they've had to do to try to downsize. So actually, the information flow is dropping, and now newsletter writers can have this much more significant role. You see that the MiFID II did not want to have any investment conferences, Brian. No New Orleans, because it's a free market system. And the only way the Denver Gold Show, Tim Wood was telling me, was able to survive through this fight was because they're not-for-profit. And basically going to shut down in Europe. And they stopped road shows. that brokers taking them from the banks, taking someone around to see different mutual funds, etc. There's on a commission, whatever, it has to come out of the trip, has to come out of their bonus. So they don't want to go on the trips. They don't want to do this stuff. So the socialist mindset of the EU is that only the government can hold an investment conference, and they should be the allocators of capital to where they deem is the best direction. And so this concept is really, is significant. I do know it got watered down to a certain degree in the U.S., but now, in the U.K., they're pushing that any shareholder can, try to petition to go on the board. And they've mandated based on gender. And then the next is going to become on sexual orientation. You've got all these things that are disruptive to, let's go to the most skilled person. Let's go to we don't care about their gender orientation. We don't care. We care about the best athlete. We care about the best musician, like Dancing with the Stars or Singing with the Stars. That type of competition, that is being really morphed in the capital markets.
Yeah, there's this big push. So, you see the politicians moving toward companies needing stakeholders instead of shareholders. They have to guarantee, and they're going to have to get chartered by the federal government to even exist, and have to guarantee that they're looking after all their stakeholders, including employees, unions, disadvantaged groups, etc., as well as and on an equal footing with their shareholders.
Yes,
yep.
and a classic to complement that statement you just made with the Denver Gold Show, you can really see the South African and European mining companies. They start their presentation off with governance and social impact, the ESG. It was shocked me. And Goldfields told me they spend $40 million a year on it. So the idea of getting a highest return on capital for you, the investor, that's not important. The ESG supersedes everything else, or they're going to have pension funds. And so if you don't have a high enough ESG rating, then none of the government pension funds are allowed to buy your mining stock. They're not allowed to buy the energy stocks. So there is a real morphing, but this all comes out of the socialist mindset, the EU. And I honestly think that President Trump should be more worried about that type of migration than a truckload of El Salvadorians coming to Mexico into Texas. Because that is so de minimis on having a real impact on entrepreneurialism, capitalism, and innovation is the how fast the Beltway Party buys into this socialist mindset of the EU. That's just my opinion, I see. But what I did do, Brian, and I noticed that the capital formation models changed, and the opportunity was that 40% of now goes in these dark pools. So really, we're only left with 60% of the trading we used to have 15 years ago. And out of that, 70% are quants. And that's high-frequency research. That's sentiment analysis research. That is not just high-frequency trading. And so I spent 8,000 hours backtesting to try to find out, what were the factors. And I was able to distill it down. And I created with an ETF called Go Gold, Go AU, and listed on the New York, and it outperformed based on backtesting the GDXJ 92% of the time. I'm rolling 12-month periods. I launched it 2 years ago, and it's done exactly that. It's far outperformed the GDXJ year to date. It's far outperformed in the past 2 years, GDX and GDXJ. And so I've discovered what those factors are that quants look at. And
what are they?
Well,
you're teasing us here. Give us the factors.
I can't really give it to you directly in that way, because then everyone's going to copy you. Then why come to me? So, the magic sauce is there's 5 major factors. It's the mixture. It's like how much salt and pepper and the ginger do you put into it. Those ratios are very important, we found. You just can't. So you go from 100 factors down to 5, and from the 5, you then go into what the best ratios are with up and down markets. And so what is important for your listeners is that book value is very important. So rising book value is an important precursor for the companies are doing well. Well, mining companies historically destroy book value. So they're not going there. Guess which mining companies do well in book value? Royalty companies.
Right.
So when they go do a financing, it's actually accretive because it's done at a premium to book value, and they go buy businesses. So there's a much broader interest in the royalty companies by non-gold fund managers than ever before. They may jump in to buy Barrick and Newmont because of the sheer liquidity, but the best performance has been owning Franco-Nevada, Royal Gold, and Wheaton River when you take a look at that versus the index. So when we created this ETF, we said that's a superior business model. We made the three amigos 10% each, and they rebalance each quarter. And then we took another sort of a factor analysis of looking at portfolio, and we went down to $200 million market caps. We couldn't go down to $100 million because then we would impact when we have a rebalance. So if it's $1 billion fund and you have 2%, you're talking about $20 million going into one stock. And so that's why we had to be sensitive of. But I've been working, Brian, on a junior mining ETF. And what are the factors? Yeah. And so a simple back of the envelope for any of your listeners is basically reserves plus cash minus the annual burn rate divided by the number of ounces.
Okay, that's easy.
So if a company issues shares of financing, the cash is treated equal to the reserves. It doesn't matter if they're inferred or proven. It's interesting enough. What's interesting for me is that most of the companies spend the cash on lifestyle or they're unlucky finding the reserves. So therefore, the reserves per share are falling. And that's the greatest decline in the reserves per share is you see those stocks have the greatest decline.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hi, this is Brian London with this week's CEO interview, wherein we interview one of the CEOs of one of the companies within the Discovery Group, which is our sponsor for the Gold Newsletter podcast. And as we know, the Discovery Group has a number of successes in its history, perhaps the greatest of which so far is Great Bear Resources. And fortunately today we're talking with the CEO of Great Bear, Chris Taylor. Chris, great to have you on today.
Great to speak with you again, Brian.
Chris, your company, I was just doing the calculation the other day, in Gold Newsletter Alert at least, the stock recently hit a high of 28 times our entry price. It's down a bit from those loftier levels, but it's still up an awful lot. Can you give a brief recap of how a company that's come as far as Great Bear has still has a lot of potential ahead of it?
Thanks, Brian. We've had some very strong success for our shareholders over the last year or so, and I think that sometimes is easy to forget that just slightly over a year ago today, we were about a 50 to 60 cent stock, and now we're several dollars, obviously, and people have made a great deal of money. So that process, effectively, if I had to encapsulate it in as few words as possible, we had a very much an outside of the box and science-based approach to our exploration work at Dixie. So we followed the gold on the project, and because we didn't worry about what rocks the gold were in or what the neighbors in the area were mining gold out of, we found these huge new gold discoveries, and we found gold that's both like what's mined in Red Lake already, high-grade gold in veins, and now this new sort of bulk tonnage, big-scale gold systems like the majors are really focused on producing from, and that also has very high-grade gold within it. So that's really what our approach was, to think outside of the box and do something different, follow the science and follow the gold, and not believe before we drilled that we had the project figured out.
Talking about that, that's a natural segue because the story has kind of evolved in market expectations as well, because initially you were getting these really beautiful ultra high grade hits typical of a deep-seated Red Lake deposit, and then you started looking at the associated, or maybe not so much associated, but nearby 18-kilometer long LP fault system where previous operators had had no success in connecting the gold hits that they had gotten historically. You were able to put it into a geological story and find that common thread, almost literally from a geological standpoint, that connects them all. And it's this 18-kilometer long structure that you're drilling up to 1 kilometer step outs along and finding consistent mineralization. And the story has kind of evolved from that high grade to really bulk tonnage, lower grade, material that really the majors are looking for. And the market has not really made that shift, I guess, in investors' minds that this is probably a better story.
Well, that's a great point, Brian, and it gives me a chance to talk about it. Now, if you just ignored in the results that we've put out from the LP fault across 3 to 4 kilometers of drilling on that thing already, if you ignored all the wide intervals of gold mineralization, the narrower high-grade gold that we've already drilled would be equivalent and in many cases better than what's mined out of veins in the Red Lake District. So you have neighbors of ours and other operators that are going into production off of usually deposits that are 2 meters wide, gold veins that are 2 meters wide of about 9 grams per ton gold on average. So people imagine that this is like multi-ounce, insane gold grades that are being mined at great depths. Generally, the resources that are being financed and going into production are in the 6 to 10 gram per ton range over narrow widths of a couple meters. Now, we've done at least that and better in many cases along this new discovery, the LP fault. What I think is interesting for people to get their minds around, and even us as the geologists drilling it, is that instead of having dead rock around the high grade zones that we keep hitting, you have these wide intervals of lower grade, moderate grade, low grade gold mineralization, very much like some of the big bulk tonnage deposit, like the Canadian Malartic deposit. The biggest mine in Canada is about a gram per ton, big open pit sort of system. We are now looking at, we still have the original high-grade vein-hosted discoveries like the Dixie Limb and the Hinge Zone that we found before. They're still there, and we have similar grades along kilometers in intercepts along this LP fault, but it's bracketed by this low-grade mineralization. So it puts a lot of words into my mouth because we're not just a high-grade story and we're not just a low-grade story. We're both of those stories together now in a way that's pretty much new for this district.
I'd like to cover 2 more points to clarify it on, because that potential really opens things up, because most junior mining companies are trying to establish strike lengths of a few hundred meters, and you're talking about at least a structural system that could stretch 18 kilometers along the LP fault, just orders of magnitude larger. But one of the keys in this last news release that you just put out was that you hit a 125 meter interval of above a gram per ton gold that was really very consistent along that entire interval. And so this is the kind of grade majors are looking for a bulk mining target. But it was at a depth of, say, over 300 meters. So it seemed pretty deep to me. But trying to visualize the geometry here, there's nothing from that intercept that does not. Have you seen anything to indicate that mineralization doesn't extend to surface, or anything that would indicate it does?
Everywhere that we've drilled along that target so far, the same stuff extends exactly to surface. Now, when you're drilling a zone like that parallels a big structure, the structure basically wiggles in terms of direction as it goes along strike. So you can set up the drill rig, and when you do the first hole, you might be right on top of the zone, or in the cases of a hole like that, because it's an angled hole, you might be 150 meters or so away from the zone. But you drill towards it, and that means you might hit it at a deeper depth, or you might hit it right at surface. You'll note that if you look over the assay results that we've been putting out along the LP fault, many of the results that we've been putting out are at 20 meters depth, 50 meters depth. And the vertical depth of the interval that you just referenced is under 200 meters where that interval starts out. And that's only a function of the fact that we stepped away from it and drilled back towards the zone. Otherwise, we could have collared a few, other than a thin layer of a few meters of gravel, you would have been right on the gold, right at your boots.
So this really is something that could be perfect for a very large-scale bulk mining type of operation. And, back when we first started talking about this project, about a year and a half ago now, actually a little bit more than a year and a half ago, we were talking about this LP fault as an 18-kilometer somewhat long target, but we were also talking about the fault that parallels it to the north, called the North Fault, and that in fact this already huge potential structural target could be duplicated. It's hard to imagine as far as you've come and how much you have ahead of you just on the LP fault, but is that a realistic potential that it could be duplicated, kind of on echelon by that North Fault?
It is a possibility. What we're seeing is that we did a type of soil geochemical survey that shows that we have other areas of potential mineralization to drill. One of those was the North Fault. Others look like they line up about along what we interpret to be other structures parallel to the LP fault and the North Fault that look like they should occur when we see the geophysics and the soil data between those two structures. So you don't just have the LP fault or just the North Fault. There are other structures that run through that package, and that would be very typical of a large fault system. It's usually not one discrete structure. It's usually a number of these things roughly in parallel, and they're all legitimate targets. So what we need to do is take the drill rigs and follow up on those and follow up on some of the other big target features that we have on the project. That's a reason that we always do regional drilling. I mean, we have this incredible consistency of hit rate when we drill off the hinge zone, the Dixie Limb zone, the LP fault zone itself. We haven't missed on any holes along it so far across many kilometers. And sometimes we take a bit of flack from investors for taking the drill rig and poking into new areas. But it's exactly that exploration process that led to the LP fault discovery in the first place. And I had a lot of people that thought we should have just buckled down and focused on the Dixie Limb zone, or we should have just focused on the hinge zone. Mm-hmm. And then the way that you make discoveries is by exploring. And that's been an incredibly fruitful process for us over the last couple of years. I would imagine, given the scale of the project and the scale of the gold system, that the potential for entirely new discoveries is very much in front of us. So that's something I really look forward to getting the rig onto as well, is to continue to test these targets and follow the gold into where it leads you, not into a particular preconceived idea.
Well, Chris, thank you so much for joining us today. So much to talk about with Great Bear Resources, so much ahead. I'm proud to say that Gold Newsletter was among the first to be onto the story, and our readers have really benefited from it. But I'm also very pleased as a shareholder personally, and as continuing to cover the company in Gold Newsletter, that there seems to be so much potential ahead of this story. So thanks again for joining us today.
Great to speak with you again, Brian. I hope to talk to you again soon.
You know, newbies coming into the sector, and we get a bunch because of who we are. We get people coming in and say, "What do I do?" And I tell them they have to dedicate at least a few $1,000s a year to subscribe to the best newsletters. A bit more than that probably to go to the few really good conferences out there and do the hard work, the homework, to really explore the sector and find the good opportunities. And if they're not willing to do that, then just invest in GDX or GDXJ. But you're saying you're coming up with a junior ETF that will kind of bridge that gap?
Yes, that's what I've been working on. I know that I can, on $10 million, it's very efficient. It outperforms by a wide margin the Vancouver index, by a wide margin. What happens when you start to blow it up to $200-300 million, you have to start having more names because you're having market impact. And once you start having market impact, then you're actually really losing. So I've been working on the sort of unique rules that I can have that I'm not going to hurt that performance, that my impact takes away my performance. But what's really important for your investors is that they look at the company's reserves. They want to make sure they have reserves. B, what their burn rate is a year, and treat cash the same. And if they hurt the reserves per share over the 12-month period, then you have to sell them. If they expand the reserves per share, then they're going to go up. Odds favor greatly.
Do these companies have to be producers in your world, or can they be developers?
No. These are all juniors. These are all developers. Exploration. This model works on none of the other ones. No producer, just the junior explorers. And what we found with the junior miners, like producers, in the GDXJ, there's been a 47% dilution, that is issuing shares or poorly thought through M&A work, where the total value of production grew on the top line, but on a per share basis it declined. And that's why it underperforms. There's been so many bad transactions or financings to expand a mine, and they don't expand it. They get into Mother Nature's glitches or environmental glitches, etc. And so it comes back to Barry Cooper's piece of research 15 years ago, that when a mining company says it's going to grow its production by 8%, on a historical basis is -6. You don't want to take forecasted production growth. It just doesn't work. So the quants look at momentum, and they'd rather look at the revenue per share the last quarter. Is it above the average for 4 quarters? If that's true, then that momentum is usually good for 9 months to 36 months. Interesting, isn't it?
It's very interesting. And, it reminds me, Frank, you've always been known as one of the guys, if not the guy, who brings the real quant perspective to the gold market. And you actually own and distribute and manage funds. You've kind of straddled the world from the real mainstream financial world to the great crazy gold bug world. Have a foot in each room, as it were. I recently saw in an interview you did on Kitco that you had said that a $10,000 gold price is no longer crazy talk. When you talk to some of your compadres in the mainstream financial world, do you talk about $10,000 gold? And if you do, what are the factors you see that could contribute to that or drive gold to those levels? And do they look at you like you're crazy?
Well, first of all, I'll give you a classic data point that'll shock you, is that over a rolling 5-year period, the 10-day volatility of the S&P is greater than gold.
That is shocking.
And gold itself is the second best performing asset class for the past 20 years. So the largest hedge fund in the world, Ray Dalio's Bridgewater, believes in gold. And so I still get this pushback on gold, and I have to come walk him in that Ray Dalio's the biggest, and gold is an important part of his asset class structure, and they all of a sudden have to show that respect for that. They're still living in denial. UBS just wrote a piece of why they're not bullish on gold. Morgan Stanley is, and I think that when I say 10,000, just makes them all go, "Are you crazy?" and I try to comment that there's some rational reasons for it, and that is there is peak gold. We did have peak oil. There was peak oil until the fractors came along. And American innovation, American creativity, American common law, which allowed people to own private land, to be able to compete on it and develop this, changed the world. But nothing like that's happening in gold mining or copper mining. And so until that's happened, we're in peak supply, and the recycling of gold is growing. And so I believe that when we look at GDP per capita for, say, Chindia, it's still growing at a very healthy rate. And the correlation of the love trade, which is 60% of all gold demand, is strongly correlated to rising GDP per capita. So if you look at the GDP per capita, the 4 big pillars of the world is America, China, India, and Japan. And so when you start taking a look at Chindia, that's 40% of the world's population, and their GDP per capita is unbelievably successful. And so it bodes well for gold demand to continue. And then you add the fear trade, which is 40%, is the unbelievable control of the monetary authority without dropping fiscal policy, streamlining it. They continue to say 0 interest rates. That is very bullish for gold. Real assets, art is good for REITs. And so I remain extremely bullish, and it'd be a non-event. And then when we look at the real inflation, not the CPI number, if you looked at the old CPI number you and I got in the business with, Brian, we have inflation running close to 9%.
Right.
I believe in that much more. So I think that reality check says, it's nothing for gold to be trading at 10,000. And when I said it, even Frank Schuster said, that's pretty ballsy to forecast the price of gold. And I said, well, it's really reasonable. And no one thought when gold was 700, it would pop to 1,900 to the crisis of 08, 09. And so I was really thrilled to hear Pierre Lassonde come out with his 30-year analysis. So he went back 30 years. He looked at the top gold producers. He looked at the top countries. He saw its change. He saw the price of gold has escalated in price. And then he did a forecast for the next 30 years. And his forecast was 5,000 to 25,000. So guess what? My 10,000 is very respectable.
Yeah, but you're old enough and smart enough in this industry to give a price but not a time. You can do one or the other, but never get the price and the time in the same prediction.
That's right. And if we get this monetary crisis starts escalating, And I'm a big believer, Brian, it's important to listen. Me getting into the crypto mining and launching the first industrial scale Hive blockchain. And we just reported, we had a great quarter. We turned the year around, happy about the corporate developments there. We run it like a royalty company. We have two employees that we're paying. And where that means we're doing $36 million in revenue, that's big revenue per employee. If you take a look at that, you're talking about $18 million in revenue per employee, and Goldman Sachs is $1 million. But what I noticed in that business was the Bank of International Settlements, how vicious and aggressive they are anti-crypto. And there was a big anti-Facebook coming into it. Oh, huge. And then I did more, and I talked to GATA about what their research was, et cetera. And they said they were involved with all the gold swaps. Yeah. And it's a very big, important factors in Europe is to try to suppress gold with gold swaps. And so they're not so aggressive talking down gold, but the fact of the narrative of how aggressive they were started me doing additional analysis and research. And it's just really, I never bought into that conspiracy theory of, what they're doing. But now Morgan Stanley, JP Morgan gets charged, the trader gets charged. Right. There's something that's out there that's real, but I believe it's the Bank of International Settlements, because they'd rather have Venezuela disaster, Argentina, Zimbabwe, because it's paper money and their 60 central banks are clearing through them. That's all they care about. And remember, it used to be a public company. I remember Adrian Day used to love the stock before they privatized it. It grew at a 45% year. I mean, it was the best thing outside of gold, is owning that, because they controlled monies around the world. So,
yeah, they were the guaranteed income because they cleared everything.
So I think that when the gold finally starts to break out and they no longer can control with their swaps, etc., and people want delivery of their gold, physical delivery is insured, just like the state of Texas said they want their gold coming from New York. They want it in safe vaults here in Texas. Mm-hmm. They don't want it being lent out and securitized, or a bank gets in problem or whatever. They don't want that. They want it here. So I think you're going to get more countries doing that, and there's going to be a breaking point. Because every time there's been a big movement of gold to a country, then all of a sudden we get these big surges in the price of gold, because it's hard to find physical gold. And so this gold has been, talk about weapons of mass destruction being these credit default swaps. I think they're all tied to gold. I think gold has much more upside. So in a New York second, I remember in January, I said in a blink of an eye, gold will jump $200. And I think it can blink in an eye jump $1,000, and not be a war, not be the normal, the world's coming to an end, etc. scenario. It'll be a ratchet, because smart people will say, I want to protect my assets, and this is my financial insurance.
Yeah, I remember I had predicted for a couple of years that once the Fed hinted that it might start cutting rates again, that gold would go up by $200. And then I was thinking back on that not long ago, thinking, wow, I was a bit too optimistic on that. But then I did the math and realized that gold had gone up $300. And it's been a relative blink of an eye. It's only been since very late May, and we've come back a bit. But, I think the monetary issues are really just guarantee much higher gold prices over the next, I think this is going to be a multi-year bull run. And what we're seeing right now is a bit of a correction, but all it's really doing is taking that froth off the top and preparing us, I think, for another big move, probably early next year. But it's coming. It's
going into election year. Absolutely. Going into election year, in the PMIs, I write about it every month. The global PMI index is the best precursor 6 months out of economic activity. It's so correlated to oil and copper and gold. So what happens is that when the PMI, the 1 month goes below 3 months, then you see copper soften, oil soften. The longer it stays 1 month below 3 months, the mathematical probability of copper and oil falling is greater. And then all of a sudden, gold starts to slip. And then we've got a global recession, rates start to crash, gold starts to surge. And that's what we're in. And so your listeners, they can go to usfunds.com and listen to my investor alert, because I really think it helps them on this monthly PMI to understand the Purchasing Manufacturers Index and the trade war. So I talked 40% of India is 40% of the world's population and consumption. of so many products in addition to gold. America and China are 40% of global trade. So when you have a beef with 40% of the global trade, then you have to have rates fall. That is the safety net is gold.
Yeah, and China and India alone consume more gold every year by considerable margin than is produced in the world in global mine production. But hearkening back to what you just said, I can't recommend highly enough that our listeners do sign up to your Investor Alert letter. You have always been known as the guy who brings the quant analysis to the gold market, and I read your stuff regularly because it brings a fresh outlook that not everybody, really hardly anybody else, is touching in the gold market. So it's really refreshing, informative, and valuable. So strongly recommend that people sign up for that.
Well, you're so kind.
Yeah, we've raced through the half hour, but we've mentioned a whole bunch of acronyms or abbreviations that many listeners may not be familiar with. So always go to goldnewsletter.com/podcast for the archives and all the details. I mean, I mentioned REITs, ESG, PMI, all these, the GDXJ. Many of the newbies may be unfamiliar with those. Daniel Duarte, our great editor, will compile those there. As Frank mentioned, his website is just usfunds.com. His email newsletter with 50,000 subscribers is Frank Talk. And you can also follow him on Twitter, Bulldog Holmes. So all the information is in the Gold Newsletter podcast archive. Frank, thanks so much for giving your time.
Thanks, Frank. Great talking with you.
And happy investing.
Cheers.
Take care.
Bye.